Along Washington's coastline, the water is no longer creeping forward quietly, it's advancing with intent. Entire stretches of shoreline are losing ground year by year, sometimes inch by inch, sometimes in violent surges that erase decades of stability overnight. In low-lying communities along Puget Sound and the outer coast, homes that once felt safely inland are now exposed to regular flooding, saltwater intrusion, and erosion that undercuts foundations without warning. Roads buckle, septic systems fail, drinking water turns brackish, and while the ocean keeps rising, the response from leadership remains slow, fragmented, and buried in bureaucratic hesitation. Sea levels in Washington are rising faster than many residents realize, driven not just by global ocean expansion but by regional land subsidence that makes the impact sharper and more immediate. In parts of the state, what climate models once projected for the distant future is already unfolding in real time. High tides now flood streets that never flooded before. Storm surges push water into neighborhoods designed for a coastline that no longer exists. Insurance costs climb or vanish entirely. Property values wobble, and families are left wondering whether the home they worked decades to afford will still be livable 5 years from now. This is not a distant environmental concern. It is a housing emergency in slow motion. Schools sit in flood-prone zones. Hospitals rely on roads that are increasingly unreliable during extreme weather. Ports, ferry terminals, and transportation corridors, the backbone of Washington's economy, face repeated disruptions that ripple far beyond the coast. When these systems fail, it isn't abstract. Kids miss school care, workers miss paychecks, entire communities lose access to basic services, not because of a sudden disaster, but because of a crisis allowed to unfold unchecked. At the center of this growing threat is state leadership that has known the risks for years. Reports have been commissioned, projections have been modeled, advisory panels have warned that delay would exponentially increase costs and human displacement. Yet meaningful action remains stalled behind funding disputes, jurisdictional confusion, and political caution. Local governments struggle to move forward without state backing. State agencies wait on legislative approval. Legislators debate timelines while tides continue to rise. Responsibility diffuses upward until no one appears accountable. For residents living on the front lines, the message feels painfully clear: adaptation is discussed, but not delivered. Coastal protections remain underfunded. Relocation plans exist largely on paper. Infrastructure upgrades move at a pace that not match the accelerating threat. Homeowners are told to prepare, but not given the tools to do so. Communities are warned but not shielded. The result is a growing sense that survival has become a private burden, not a public priority. What makes this moment especially dangerous is the illusion of time. Sea level rise does not announce itself with sirens, it advances quietly between election cycles. Damage accumulates gradually, then suddenly becomes irreversible. By the time officials agree on the scale of intervention required, entire neighborhoods may already be unsalvageable. Costs multiply, options disappear. What could have been prevented becomes something that must be endured. And this is why Washington now stands on edge. Not because the science is unclear. Not because solutions are unknown, but because hesitation has become policy, and delay has become the default response to an escalating threat. The water does not negotiate, it does not wait for budget cycles, it does not pause for political consensus. This crisis didn't arrive without warning. And what allowed it to reach this point is far more unsettling than the rising sea itself. There's a specific price zone in gold that traders, central banks, and hedge funds are watching like a hawk. It's not a random number, it's not hype, it's a structural level that has quietly held the global financial system together for years. And if gold breaks it in 2026, the consequences won't stay confined to commodity charts. They'll spill straight into currencies, bonds, equities, and geopolitics. That level sits near the long-term inflation-adjusted resistance zone, a range gold has tested repeatedly during moments of extreme stress: the 2008 financial crisis, the COVID shock, and the post-22 inflation surge. Each time gold approached it, rattled markets, and then pulled back just enough to prevent a full-blown confidence collapse. But here's the problem: every test weakens resistance, and 2026 may be the year it finally gives way. What makes this moment different is who is buying gold and why. This isn't retail panic or speculative mania. Central banks are leading the charge. According to World Gold Council data from recent years, central bank gold purchases have hit multi-decade highs, with countries like China, Russia, Turkey, and several Middle Eastern nations accelerating accumulation. This isn't about returns, it's about trust, or more accurately, the lack of it. Gold rises when faith in paper systems erodes. And right now, that erosion is happening quietly but relentlessly. Government debt levels across major economies are exploding. The US alone is running deficits measured in trillions, even outside recession. Japan is trapped in a debt spiral. Europe is struggling to balance growth with fiscal discipline. Meanwhile, interest rates, once a tool to control inflation, are now a threat to government solvency themselves. Here's where gold becomes dangerous. If gold breaks above this critical level, It sends a signal that markets no longer believe central banks can control inflation without breaking something. It tells investors that real yields are effectively dead. And it suggests that currency debasement isn't a temporary policy choice, it's structural. Historically, when gold confirms that message, capital starts moving fast, not gradually, not politely. Bonds sell off as investors demand higher yields to compensate for inflation risk. Stocks become volatile as discount rates rise and earnings projections crack. Emerging markets feel the shock first through capital outflows and currency pressure. Developed markets feel it next, through instability they aren't used to managing. And there's another layer most people miss. Gold breaking this level would also expose the fragility of the derivatives market tied to precious metals. Paper gold vastly outweighs physical supply. Futures contracts, ETFs, and synthetic exposure work only as long as confidence remains intact. A sustained breakout would raise uncomfortable questions. Who actually owns the gold? How much physical metal is available? And what happens if delivery is demanded at scale? That's when markets snap, not because gold is too high, but because it reveals truths investors were avoiding. It exposes that money has been stretched thinner than advertised, that debt is being monetized, not managed, and that central banks are reacting, not leading. This is why analysts aren't just watching gold as a commodity. They're watching it as a stress gauge for the entire financial system. A break above this level in 2026 wouldn't be a victory lap for gold bugs. It would be a warning flare, bright, unmistakable, and impossible to ignore. And once that flare goes up, history shows markets don't calmly adjust, they reprice reality all at once. When gold makes a decisive move higher, the damage doesn't start in the gold market itself. It starts quietly in places most investors aren't watching: bond yields, currency pairs, liquidity spreads, and balance sheets that were never designed to handle sustained instability. Gold isn't the cause of the crisis, it's the confirmation. And once that confirmation arrives, markets don't debate it, they react. The first crack appears in government bonds. A sustained breakout in gold tells investors that inflation risk is no longer transitory, contained, or manageable. It means the real value of fixed income returns is eroding faster than policymakers admit. When that realization spreads, bondholders demand higher yields to compensate, or they exit entirely. That pushes borrowing costs higher at the exact moment governments need cheap financing the most. This is the trap: raising rates worsens debt stress, but cutting rates fuels inflation expectations, and both outcomes push gold higher, reinforcing the cycle. Equities don't escape this either, despite the popular narrative that stocks are an inflation hedge. They aren't, not when inflation is driven by debt monetization and currency debasement rather than productivity growth. Higher yields compress valuations. Corporate refinancing becomes more expensive. Profit margins shrink as input costs rise faster than consumer demand. The market stops rewarding growth stories and starts punishing leverage. Companies that survived years of cheap money suddenly face a reality they've never operated in before. At the same time, currencies begin to fracture. When gold rises sharply, it exposes which currencies are backed by credibility and which are backed by promises. Capital flows away from weaker fiscal regimes and into perceived safe havens, but even those havens start to feel stress. The US dollar may initially benefit, but a gold breakout driven by US debt and deficits eventually undermines confidence in the dollar itself. That's when volatility accelerates across forex markets, and central banks are forced into reactive, often contradictory. Real estate, often seen as a stable store of value, enters the danger zone next. Higher yields mean higher mortgage rates. Transactions slow, prices stall. Then liquidity dries up. Highly leveraged property markets, commercial real estate in particular, are the most vulnerable. Refinancing risk rises sharply, defaults increase, and banks tighten lending standards not out of caution, but necessity. This feeds back into the broader economy through reduced credit availability, slowing growth even further. What makes this phase especially dangerous is that it unfolds while official narratives remain calm. Policymakers will frame it as adjustment, normalization, or temporary volatility, but markets don't respond to language, they respond to math. And the math becomes brutal when debt, rates, and inflation move against each other at the same time. Retail investors are usually the last to realize what's happening. By the time headlines turn openly negative, portfolios have already taken the hit. Retirement accounts feel the pressure, savings lose purchasing power, risk assets become unpredictable. The sense of stability people rely on, steady returns, predictable growth, manageable inflation, begins to fracture. Gold doesn't rally because people want to get rich. It rallies because people want to opt out. Out of currencies losing value, out of bonds offering negative real returns, out of systems that require constant intervention to function. That's why a gold breakout is never isolated. It's systemic, and this is the part most forecasts ignore. Once markets accept that intervention no longer restores confidence, reactions become nonlinear. Moves that were once gradual turn sharp, correlations break. Liquidity vanishes when it's needed most. This is where history shows the greatest damage occurs, not during the buildup but during the realization. By the time gold's message is fully understood, the repricing is already underway. The most dangerous part of the current gold setup isn't inflation itself, it's the shrinking set of options left to central banks. For decades, monetary authorities relied on a simple playbook: cut rates during downturns, raise them during overheating, and use credibility as a stabilizer. That playbook no longer works. Debt levels are too high, financial markets are too interconnected, and political tolerance for economic pain is too low. When gold starts signaling stress, it's because markets understand this constraint long before officials admit it. Central banks today are not fighting inflation from a position of strength. They are fighting it while sitting on balance sheets swollen by years of quantitative easing, emergency lending facilities, and asset purchases that were never meant to be permanent. Every rate hike increases interest expenses on government debt. Every rate cut risks reigniting inflation expectations. This is not a policy dilemma, it's a policy deadlock. And gold thrives in deadlocks. When investors see central banks hesitate, delay, or reverse course, they don't interpret it as caution. They interpret it as loss of control. Forward guidance becomes meaningless when conditions change faster than messaging. Markets stop listening to speeches and start watching behavior. Are rates really restrictive if fiscal spending continues unchecked? Is inflation really defeated if money supply quietly expands through other channels? These contradictions don't go unnoticed. They accumulate, and gold absorbs that distrust. Currency debasement doesn't happen overnight. It happens through a series of small, defensible decisions that all point in the same direction. Emergency liquidity here, targeted support there, quiet regulatory forbearance. Each action seems reasonable in isolation, but together they dilute purchasing power. Gold doesn't need an announcement to respond, it responds to the trajectory. When that trajectory becomes clear, price action accelerates. By 2026, timing becomes the real issue. Not whether central banks will intervene, but when they are forced to intervene again. Markets are forward-looking machines. If investors believe rate cuts are inevitable due to debt stress or political pressure, they will price that future into assets immediately. That's why gold often moves before official pivots, not after them. It reacts to inevitability, not confirmation. This is where credibility fractures globally. Not all currencies weaken at the same speed, but all fiat systems share one vulnerability: they rely on trust. Trust that inflation will be controlled. Trust that debt will remain serviceable. Trust that central banks will act independently. Once the trust erodes, diversification away from paper assets accelerates. Gold becomes less of a trade and more of a reserve asset again. Emerging markets feel this pressure first, but developed economies are no longer immune. High debt to GDP ratios, aging populations, and political resistance to austerity make sustained tight policy unrealistic. Markets know this. That knowledge is reflected in yield curves, gold prices, and capital flows long before it shows up in official data. What makes this moment especially volatile is that central banks are reacting not just to economics, but to optics. Sharp downturns are politically unacceptable. Financial instability is feared more than inflation. That bias shapes decisions, and markets price that bias in real time. Gold rises not because inflation is high today, but because inflation is likely to be tolerated tomorrow. Once investors accept that monetary policy is constrained by debt rather than guided by discipline, the perception of risk changes fundamentally. Cash is no longer neutral. Bonds are no longer safe by default. Even equities become conditional bets on policy support. Gold stands apart because it doesn't depend on permission, credibility, or compliance. This is why a gold breakout heading in 2026 is not about optimism or fear, it's about realism. Markets aren't panicking. They're adjusting to a system where central banks can slow damage but not reverse it, and when that realization sets in broadly, price movements stop being gradual, they become decisive. As 2026 approaches, the convergence of debt, inflation, and constrained monetary policy is creating conditions for a market tipping point that could shake the global financial system. If gold breaks decisively above key resistance levels, it won't be a minor correction or a fleeting spike. This will be a structural shift in how investors, governments, and everyday people perceive value. The first casualties won't just be traders, they'll be ordinary citizens whose savings, pensions, and purchasing power are implicitly tied to fiat currency stability. When gold rises sharply, it reflects a loss of confidence in paper assets. Bonds become unattractive, currencies weaken, and equities are re-evaluated based on solvency risk rather than growth potential. Sovereign debt markets in Europe and North America, already burdened with trillions in obligations, will be the first to react. Countries that relied on historically low borrowing costs to fund social programs, infrastructure, or emergency spending will face surging yields. That translates immediately into higher interest payments, budget cuts, and political pressure. Governments can delay, but they cannot escape the reality of rising debt servicing costs. At the individual level, households will feel the strain in multiple ways. Mortgage rates will spike if bonds move in tandem with gold. Consumer credit costs will increase. Inflation, already persistent in certain sectors, will intensify as energy, housing, and food prices climb under the weight of disrupted supply chains and currency weakness. People living paycheck to paycheck will be hit hardest, while those relying on savings in cash or bonds will see real wealth erode. The wealth gap will widen further as tangible assets like gold, real estate, and commodities outperform nominal financial assets. Corporations will not be immune. Multinational companies with debt denominated in fiat currencies will face higher interest expenses. Operating margins will compress as input costs rise and consumer demand shifts. Businesses that have over-leveraged during low-rate years may face restructuring or bankruptcy. Emerging market corporations, particularly those reliant on U.S. dollar funding, will experience amplified pressure, potentially triggering capital flight back to perceived safe havens. Gold, historically, benefits directly from these capital rotations, as investors seek refuge in an asset that cannot be debased by central bank policies. Central banks, meanwhile, will be trapped between a rock and a hard place. Attempting to counter a gold-driven flight into safety with higher rates could choke economic growth, risking recession. Attempting to stabilize markets by easing policy risks further undermining credibility and accelerating inflation. Every move will be scrutinized in real time, magnifying volatility. The era of predictable interventions will be over. Markets will no longer trust soft signals or incremental adjustments. Gold thrives in uncertainty, and the faster central banks react, the more dramatic the market response becomes. This tipping point also carries geopolitical implications. Nations heavily reliant on dollar reserves or those with fragile fiscal positions will confront a strategic choice: defend currency stability at massive cost or allow adjustment and risk social unrest. Trade flows, energy contracts, and debt repayments could all be disrupted. Countries sitting on large gold reserves may suddenly hold asymmetric power, while those without will scramble to hedge exposure. It's a dynamic that can create sudden, sharp realignments in global influence, something rarely seen in peaceful markets. The reality for the average person is stark. When gold rises as a signal of systemic stress, it is not an isolated event. It is a cascading alert system for every corner of the economy. Prices rise, purchasing power falls, debt burdens increase, and uncertainty becomes the dominant lens through which financial decisions are made. For investors, policymakers, and households alike, the key question isn't whether this will happen, it's how prepared they are when it does. The longer authorities hesitate, the sharper the adjustment will be, and the fewer warning signs ordinary people will see until the first waves hit. When gold breaks decisively, the consequences will be immediate, far-reaching, and unavoidable. It will mark a turning point where perception of risk overtakes traditional metrics, and reality forces action, often too late for those caught unprepared. This is not a forecast of panic. It is a sober acknowledgement of structural realities. Those who ignore it will learn the cost the hard way, while those who understand it may find opportunity in the midst of systemic upheaval. The world will be watching, but only the prepared will act before it's too late.